Hi guys, today I'm going to be talking about the 3 key metrics that are going to safeguard your investment. By just checking these 3 key metrics, you can check for yourself easily if this investment is safe for you or not. Not doing so can cause you to lose a lot of money when things turn out wrong. But before we go into the video, please smash that like button to let the YouTube algorithm know that you like this video, subscribe to the channel, and of course, leave a comment if you have any questions. Let's jump right into it with the first metric I find the most important of all, and that is the debt to equity ratio. Basically meaning how much debt does the company have towards the equity the company has. Equity is how much the shareholders own within the company, whereas debt is how much long-term debt the company owes to others. For example, when you buy a house. If you buy a house for $100,000 and you loan $60,000 to buy that house, you then have $60,000 debt, $40,000 equity within that $100,000. Now, to bring this into perspective of a company and their stocks, a great debt to equity ratio is 50%. This is what I consider a safe company. Whereas a company with 125% debt to equity ratio is considered a very risky investment because you're basically buying their debt. Would you buy a house worth $100,000 for $125,000? No, right? It wouldn't make any sense. So why would you buy stocks then with 125% debt to equity ratio? I see time and time again companies being hyped up by gurus for these very big future earning potentials. But if you look at their debt to equity ratio, you see that they basically have a huge amount of debt, which is fueling their growth. Basically, you're taking a huge risk when investing into these type of companies. Second key factor I look at is to make sure that the company is not going to get into trouble with their short-term debt. And this ratio is basically the current ratio. This basically shows you how easily they can pay off their short-term debts with their short-term assets. All short-term debts that they need to pay within 12 months time. And short-term assets are basically things that they can turn into cash quickly, like inventory or money that they're owed by other people, or the cash that they have on hand itself. The reason I find this metric important is that if they can't pay off their short-term debts, that means they're going to have to take on more long-term debt to get more cash on hand to pay for these debts, which will definitely have a negative side effect on their debt to equity ratio. A great current ratio for a company is 1.5. Basically, that means that they can pay off their short-term debts 1.5 times with their short-term assets. This means you can feel secure that they'll pay off all their short-term debts with their short-term assets without having to take on any long-term debts. Lastly, the third metric is what's called the quick ratio, and this is not used for all companies. Basically, the quick ratio is how easily they can pay off their short-term debts with their short-term assets without taking the inventory into account. So companies that don't have an inventory don't use this metric at all. So why is the quick ratio important? Well, let's say a market crash happens and people can't sell their inventory anymore. It's good to check if they will be able to pay off all their short-term debts with their short-term assets without their inventory. What do you think is going to happen with the inventory that they have? Are they still going to sell all of that inventory? Probably not, but they still need to pay off their short-term debts. So what we want to check is how easily are they able to pay off their short-term debts without taking into consideration the inventory that they have, that they might not be able to sell. So the quick ratio shows you how easily they can weather the storm in the case of a market crash happening, even though they won't be able to sell their inventory. This means they won't be needing to take on any long-term debt because they have all the liquidity they need. A great quick ratio is at least 1, meaning that they can pay off all of their short-term debts with their short-term assets without taking into consideration the inventory. That means even if they sell nothing, they can still pay off all their short-term debts, meaning you're safe because they don't need to take on any more long-term debt. So guys, let's go over the 3 main ratios. The first one is the debt to equity ratio. We want to keep this at 50%. Having this at 50% shows you if the company has enough equity so that you're not buying a company with debt. Secondly, we have the current ratio, great at 1.5. This means that the company will never get into short-term debt problems, meaning that they have to take on more long-term debt, resulting in your equity being hurt. Thirdly, we have the quick ratio, which easily shows you how easily they can pay off all their short-term debts without their inventory, which we want to keep at a good ratio of at least 1. Keeping these 3 aspects in mind will keep you ahead of most of the investors out there. Now guys, if you like this video, please smash that like button, subscribe to the channel, and if you have any ideas for future videos, please leave a comment below and I'll get back to you. Thanks for watching, until next time.